Good morning, everybody. Welcome to another Daily Market Report brought to you by Mike Bjork. Today is Monday. It's December 17th. Hope you guys had a great weekend here. Hey, we got a couple items here on the economic calendar. We'll start off with the Empire State Index. This is the manufacturing data out of the New York region. And as you can see here, we had a pretty good month in November at 23.3, but however, it did dip quite a bit here. It had a pretty sharp drop down to 10.9, which is obviously not very good news here. We also got the Home Builders Index for the month of December. This is an index that gauges the confidence level for home builders as they determine if they want to continue uh, building or not. And anything on this index above 50 is considered optimism and expansion, or contraction or pessimism below 50. And as you can see here, we had a pretty good range here at 60 before at 90 in November, but it dipped down to 56. This is the lowest level we've seen since May of 2015, and it is a bit concerning that they have dropped so far. And of course, a lot of this is due to the sentiment out there. They're probably not seeing as much traffic from home buyers and stuff, and things have slowed up a little bit. So I think they're probably not feeling as comfortable where things are at currently in this current state. Special interest rates are as high as they are right now. Not that they're really high, because they are still relatively low. You're talking low fives, where we've been much higher in the past. So kind of relative. Right now, the stock market's mixed. It's been kind of going back and forth. Currently, the Dow is down. It was even down much further, down like 100 now. Last time, as I'm preparing this, it was down about 24. So a bit of movement there. They're just kind of nothing really on the news that's kind of sticking out. They're just kind of looking at what they have been looking, and that is uh, the Fed rate hikes. Speaking of such, Fed will be meeting, having its two-day meeting start beginning tomorrow. And they'll announce their any rate hikes on Wednesday, which is widely expected that they are going to raise it a quarter point. With that, with that rate hike, it should put us into a negative yield curve. Now, there has been talk since the last month or so. Some Fed members, we had a dot plot showing three rate hikes for 2019. At this meeting, the investors are going to be, they're expecting this rate hike, but they're going to be looking ahead to any future rate hikes. And since this over last month, we've been hearing some Fed members kind of giving some more or less dovish tones, saying that we're near neutral level, that kind of almost at the end of it, depending on where economy is. So when they give their announcement, don't look really for a commitment yet from them. They're probably going to hold off any commitment about future rate hikes, primarily because they want to see where because they do see the economy as a whole. I mean, global economy, not just the U.S. U.S. is doing actually quite well, but the global economy is slowing down a bit, and we see the dollar rising. Oil prices have come down of late. Inflation's still been in check, so they're watching all that stuff. And probably the next meeting in January probably won't have a rate hike, but if there's a next, if they do, probably as soon as they'll do it in 19 would be March. And they'll probably want to wait and see what kind of data we have between now and March before they decide if they do another rate hike. So look for a kind of non-committal on Wednesday type of speech from him, from Fed Chairman Powell. And I don't think investors will like that as much, because they're going to want more information, and that uncertainty is going to make the markets unsettle. So that might affect the stock markets more negatively. So be cautious out there in that level there. So and the other things, of course, are the U.S. and China relations, and then of course the slowing global economy, as I mentioned, as we've had reports in Europe and China that they had some poor economic data that came out, and that was concerning to investors. So let's see how it's affecting the bond market. Bond market is doing decent. We're actually up about 8 basis points from where we left off on Friday. The nice thing for us is that we have this double layer of support here, which is going to help us out. We do got this layer, we have 200-day moving average, which is pretty strong. As you see, it's kept us in check here. But we got more upside here to work with. So definitely I would recommend floating. Always, of course, I would recommend keeping your finger on the trigger in case you need to lock in. But right now, I think we got more potential for upside here, and improvement in the rates here a little bit. As you can see here, we got we had hit already this floor of support at this Fibonacci level. And since then, we were raising last week, and then as soon as we hit that ceiling, we started coming downwards. And we got a little bit of room until we hit that. We could most likely hit that Fibonacci level here in the 10-year Treasury, which is why I kind of said the mortgage-backed securities got probably more potential to go upwards and get some improvement. Right now, we're down about 2.87 on the 10-year Treasury. And again, this is helping mortgage-backed securities as a result, and or interest rates in that matter. So that pretty much wraps things up. Rates are not quite enough improvement in there to see improvement in pricing, but it's showing that trend there, and we could see that maybe later today or tomorrow. It depends if it kind of takes off or not. So today's just kind of one of those shaky days. But again, tomorrow we do got a lot of data coming out this week, so be prepared for some volatility. And of course, we got the Fed, which could really break things open on Wednesday, depending on what is said and what's if there's not commit or not. So, and we could take the bond market could take its cue from the stock market on Wednesday. So they go what they have, the flight up to safety. So if the stock market doesn't like what the Fed is saying, it'll move the money into mortgage-backed securities typically, and that will help us out with some improvements there. Meanwhile, if there's any changes, I will post on Twitter as I usually do, especially when the market closes every day. I post over there. So if you want to get those updates or check to see where the market is, you can follow me at Mike Bjork on Twitter. Otherwise, have a great rest of your day. Thanks so much for watching. We'll see you guys tomorrow. Bye bye.